Your buddy makes $100,000 a year at his job. You make $100,000 a year in retirement. He pays over $15,000 in taxes. You pay $290. Same income, 50 times less tax. I'm not talking about some offshore scheme or tax loophole that gets you audited. I'm talking about the actual US tax code, the one that applies to everyone, the one nobody seems to explain properly, because the financial services industry makes more money if you think you need $3 million in your 401k to retire comfortably. I watched my accountant walk a client through their first retirement year tax return. Guy kept asking him to run it again. Couldn't believe the number. His tax bill dropped from $18,000 to under $500 on the exact same income, not because he hired some expensive tax attorney, just because he turned 65 and the IRS has two completely different rulebooks. Here's what I'm going to show you. The tax system doesn't just give retirees a discount. It fundamentally restructures how income gets counted, what gets taxed, and at what rates. FICA taxes vanish. Social Security becomes partially invisible. Capital gains drop to 0%. And deductions stack so aggressively, they make your working years look like you were paying a voluntary surcharge just for being employed. By the end of this, you'll understand why most people dramatically overestimate how much they need in retirement, and why that overestimation keeps them working years longer than necessary. Think of it like this. There are two restaurants in the same building. Same menu, same portions. One charges full price, adds a mandatory service fee, no discount card. The other one, you walk in at 65, half your meal is comped, the service fee disappears, they hand you a card that cuts a quarter of your bill. Same building, same food, completely different economics. That's the gap between working income and retirement income. You're not changing what you consume. You're changing which set of rules applies to you. Let me start with Social Security taxation, because this is where it gets weird. When you're working and earning $100,000, every single dollar is taxable. The IRS sees $100,000, they tax $100,000. Clean, simple, brutal. Social Security operates on a different planet. At most, 85% of it can be taxed. For most retirees, the actual percentage is way lower. There's this calculation called provisional income. The IRS takes your adjusted gross income, adds in half your Social Security, adds any tax-exempt interest. That total determines what percentage of your Social Security becomes taxable. Structure it right, and you can easily get to a situation where only 40 to 50% of your Social Security counts as income. So if you're getting $40,000 a year from Social Security, the IRS might only see $20,000 of it. The other $20,000 just exists in this invisible zone. You spend it, you live on it, but for tax purposes, it doesn't count. I had a lawyer explain this to me back in 2018. I genuinely thought he was describing fraud. He had to pull up the actual tax code. Nope. Completely legal, completely intentional. Here's where it compounds. Once you understand Social Security is partially invisible, you start to see how the whole structure tilts. You take that $40,000 from Social Security, only $20,000 counts. Then you pull $30,000 from your IRA, that's fully taxable. But your total taxable income is now only $50,000, not $70,000. You're living on $70,000, the IRS sees $50,000. That gap is where the game gets played. And because your taxable income looks lower than it actually is, you start falling into different brackets for everything else. Capital gains brackets, deduction thresholds, all of it recalculates based on this artificially lower number. Now FICA. When you're working, you pay 7.65% to Social Security and Medicare on every dollar you earn. Your employer matches it, total hit is 15.3%, but you're directly paying 7.65% on $100,000. That's $7,650 evaporating into FICA every year for your entire working life. The moment you retire, that entire line item goes to zero. You don't pay FICA on Social Security benefits, you don't pay it on IRA distributions, you don't pay it on capital gains. You don't pay it on dividends. It just stops. A couple making $100,000 in W-2 income loses $7,650 to FICA. A couple making $100,000 in retirement income loses zero. That's a 7.65% automatic raise just for aging out of the system. FICA is basically a subscription fee for permission to work. The second you stop working, the subscription cancels. But you're probably thinking, okay, FICA disappears, Social Security is partly invisible, but I still have to pull money from my IRA, and that's fully taxable. So what's the real difference? This is where the deduction stacking starts. When you're working and under 65, you get the standard deduction. For 2026, that's around $32,000 for a married couple. Once you hit 65, that number jumps. You get an additional $3,900 per person just for being old. That's another $7,800 in deductions, no questions asked. Then there's this enhanced senior deduction that adds another $6,000 per spouse if you're over 65. That's $12,000 total. Now, your standard deduction isn't $32,000. It's over $46,000. You can earn $46,000, and the IRS pretends you earned zero. Now, to be fair, the enhanced senior deduction isn't permanent. Congress might change it, it's set to phase out. But the core structure, Social Security being partially exempt, FICA disappearing, the senior bump to the standard deduction, that's been in the tax code for decades. It's not new. It's just weirdly under-discussed because if you realize you only needed $1.5 million instead of $3 million to retire, a lot of financial advisors would make less in fees. Here's the fourth piece, and this one makes the least sense if you think about tax policy logically. Capital gains. Long-term capital gains have their own bracket system, separate from ordinary income. If your taxable income is below a certain threshold, currently around $96,000 for a married couple, your long-term capital gains are taxed at 0%. Not a low rate, zero. And remember, your taxable income is calculated after Social Security's partial exemption and after all those stacked deductions. So you could have $100,000 in actual cash flow. But after the IRS does its math, your taxable income might be $30,000, which means any long-term capital gains you realize up to the threshold are completely tax-free. You can sell stocks, take the gain, live off the money, pay zero federal tax on it. I was at a conference in 2024, wealth management thing. Guy on stage was explaining tax loss harvesting strategies to minimize capital gains. Very technical. During the Q&A, someone asked why he didn't mention the 0% bracket. He paused, visibly uncomfortable, said, "That's more of a niche case." It's not niche. It's the default state for half of retirees if they structure their withdrawals correctly. But if advisors told clients that, clients might realize they don't need to pay 1% fees on $2 million to retire at 60. Let me make this concrete. Take two couples. Couple A is 60 years old, both working combined W-2 income of $100,000. Couple B is 70 years old, both retired, combined income of $100,000. Same number, completely different outcomes. Couple A gets the standard deduction of about $32,000, leaving them $68,000 in taxable income. Federal tax on that is roughly $7,700. Then FICA hits for another $7,600. Total tax bill, $15,400. Effective rate, 15.4%. Couple B gets $40,000 from Social Security, but only 49% of it counts as taxable. So the IRS sees $19,600. They pull $30,000 from their IRA, fully taxable, and they realize $10,000 in long-term capital gains from their brokerage account. Total income, $100,000. But the capital gains get taxed at zero because their taxable income is low enough. So the IRS is really only looking at $49,600. Then the deductions hit. Standard deduction of $32,000. Senior bump of $7,800. Enhanced deduction of $12,000. That's $46,800 in deductions. Taxable income drops to $12,800. Federal tax on that, under $300. No FICA because they're not working. Total tax bill, $290. Effective rate, 0.3%. Same income. 50 times less tax. The working couple keeps $84,600 after tax. The retired couple keeps $99,710. That's over $15,000 more per year in their pocket, or about $1,260 per month. Not because they're richer, not because they have better accountants, just because the tax code is fundamentally kinder to retirees than workers. Picture the IRS agent reviewing these returns. You see couple A, working, paying $15,000. You see couple B, retired, same income, paying $300. Does the agent go, hey, this seems unfair to the working people? No. The agent goes, cool, both returns are compliant. Next. Because it's not a bug, it's the design. The system wants to encourage retirement savings and wants to avoid taxing retirees into poverty. Noble goals? Maybe. But the side effect is that workers are dramatically overpaying relative to what they'll actually need in retirement. Now here's where this gets psychologically interesting. Most retirement calculators ask you, what percentage of your pre-retirement income do you need to maintain your lifestyle? Standard advice is 80 to 90%, some say 100% to be conservative. But that advice assumes your tax situation stays the same. It doesn't. If you're used to living on $85,000 after tax while earning $100,000, you don't need $100,000 in retirement to maintain that lifestyle. You might only need $70,000 or $75,000 in gross retirement income because the tax burden is so much lower that your after-tax spending power is the same or higher. Think about what that means for your savings target. If you thought you needed $2 million to generate $100,000 a year at a 5% withdrawal rate, but you actually only need $75,000, now you only need $1.5 million. That's $500,000 less you have to save. That's years of extra work you don't have to do. This is where people make catastrophic errors. They spend their 40s and 50s in panic mode, convinced they're behind, convinced they need to save more, work longer, delay retirement. Some people genuinely are behind, but a lot of people are oversaving because they're calculating their retirement needs based on their working years tax rate. They're solving for the wrong number. I watched this happen in real time. A friend of mine ran his own consulting business, was convinced he needed $3 million to retire at 60 because he was pulling in $200,000 a year and wanted to maintain his lifestyle. I walked him through this exact structure, showed him that if he could generate $150,000 in retirement income, structured correctly, his after-tax number would be close to what he was living on at $200,000 while working. His savings target dropped by almost a third. He retired at 58 instead of 65. That's 7 years of life he got back just from understanding the tax code. Picture a financial advisor hearing this. You walk into their office and say, I just learned that I actually need way less in retirement than you've been telling me because of the tax structure. The advisor's face does this little twitch because if you need less, you save less, and if you save less, they earn less in fees. So they pivot to, well, you also need to account for healthcare costs, inflation, longevity risk, sequence of returns risk, all valid concerns, but also very convenient concerns that keep your target savings number high. I'm not saying advisors are evil. I'm saying incentives matter. And an advisor getting paid on assets under management has zero incentive to tell you that you might be oversaving. Here's the thing nobody wants to say out loud. The financial services industry benefits massively from retirement fear. The more terrified you are of running out of money, the more you save, the more fees they collect, the more insurance products they sell. And the tax code's generosity to retirees undermines that fear. If people realized how much less they'd actually pay in retirement, they might relax a little. They might work less, save less, live more. And that's bad for business. So the information stays obscure. Not hidden, just under-discussed. You can find it if you dig into the tax code or hire a good CPA, but it's not in the front window of every Fidelity branch. Let me be clear about what I'm not saying. I'm not saying don't save for retirement. I'm not saying the tax advantages make retirement trivially easy. Healthcare costs are real, inflation is real, living to 95 is a real possibility, and you need liquidity for that. What I am saying is that the standard advice dramatically overstates how much gross income you'll need because it ignores the tax structure shift. And that overstatement has consequences. It keeps people working longer than they need to. It creates anxiety that compounds into bad decisions, like panic selling in downturns or chasing yield in garbage investments. Lazy investing built more fortune than crypto memes. And part of lazy investing is understanding that the system has certain built-in advantages you're supposed to use. The tax code isn't your enemy in retirement. It's actually trying to help in its weird bureaucratic way. But you have to know the rules exist to play the game. So 3 things you need to do with this information. First, recalculate your retirement income needs based on after-tax spending, not gross income. Actually run the numbers. Figure out what you spend now after tax, then model what gross retirement income generates that same after-tax number given the structures I just described. You'll probably find your target is 10 to 20% lower than you thought. Second, structure your retirement accounts with tax diversity in mind. You want money in traditional IRAs, Roth IRAs, and taxable brokerage accounts, because pulling from different buckets lets you optimize for these tax brackets every year. You can fill up the 0% capital gains bracket, take some IRA distributions, pull Social Security all in the same year, engineering your taxable income to stay in the sweet spot. Third, if you're over 50 and realistically 10 years from retirement, go talk to a CPA who specializes in retirement tax planning, not a financial advisor who sells products. A CPA who gets paid to minimize your taxes. Have them run projections for your specific situation, because everyone's numbers are different, but the framework I just laid out applies universally. And here's the cynical close. The system is designed this way on purpose, but not because Congress loves retirees. It's because retirees vote at much higher rates than workers. Old people show up to elections. Workers are too busy working. So the tax code gives retirees a better deal, and everyone in politics pretends it's about dignity and fairness. Maybe it is, or maybe it's just about who has time to vote on a Tuesday. Either way, the structure exists. You might as well use it. You came here thinking 100,000 working versus 100,000 retired was the same thing. Now you know it's not even close. One pays 15,000 in tax, the other pays under 300. That gap is real money, it's years of your life, and it's sitting right there in the tax code waiting for you to turn 65.